All right. Assalamu alaikum. Welcome, everyone. Great to have you here. Today, we're digging into an important question. Are you unknowingly leaving valuable tax savings on the table? So we plan to explore the often overlooked costs of focusing solely on tax preparation, especially with tax day right behind us, versus taking a more strategic, long-term approach through proactive tax planning. So a quick housekeeping note before we dive in. This webinar is being recorded and all registrants are going to receive a copy afterwards. And just a reminder, the information that we'll be sharing today is educational in nature, but it's not meant to be it's not meant to be personalized tax advice. So please be sure to speak with your tax advisor before you implement any of the strategies we'll be discussing today. So before we dive in, let me introduce our team. My name is Tamim Qasim. I'm a financial associate here at Azad. I'll be explaining the difference between tax filing and tax planning. A little later, I'll also review some of the tax changes that may impact you this year. I'm also happy to be joined by my colleague Ata Khan, also a financial associate. Ata Khan holds his uniform his investment advisor license, his Series 65, and also a master's in finance. He'll be discussing the potential changes to the tax code that may be occurring with the new administration and some fiscal policies that may be impacting it. We're also happy to be joined by my colleague Reem Hussain. She's our Chief Planning Officer. She holds her CFP designation as well as a PhD in Financial Planning and Wealth Management. She'll be walking us through a case study showing how we approach a real tax planning situation here at Izzad. So welcome, Ata and Reem. So for those of you who may need a quick refresher, here's a little bit of information about us. For over 25 years, Izzad has income professionals, businesses, and nonprofits grow and preserve their wealth, all in accordance with Islamic values. Today, alhamdulillah, we've been privileged to earn the trust of clients across the United States, and we now manage approximately $1.5 billion for more than 1,000 clients across all 50 states. What sets Izzad apart is the nature and quality of our advice. Our work is centered on you and your family, guided by a higher purpose and designed to help bring you greater peace of mind. Besides tax planning, we offer a comprehensive set of planning services as well. This includes retirement, estate planning, cash flow planning, and much more. And of course, we manage our clients' money all in accordance with Islamic guidelines. So with that, let's jump into our content for today. So why is tax planning important? So taxes, they touch every part of your financial life, uh, to the point where your tax return is like a financial fingerprint. It's very unique to you. It's got clues about your income, your savings, and your liabilities. And for us as financial professionals, by understanding these details, we can actually help you unlock opportunities for smarter tax planning. So I get asked all the time when I speak with prospects and clients who hear this term tax planning. It oftentimes gets conflated with tax filing. So what is the difference between tax planning and tax filing, which are actually two very different things? So while they both deal with taxes, they serve very different roles in your financial life. Tax filing is more about compliance. It's more about making sure that you're reporting your income and your deductions correctly to the IRS. It's a very necessary annual process. Um, it's more about keeping track of what happened in the past. On the other hand, tax planning is more of a forward-thinking strategy. It's about making smart decisions year round and throughout your lifetime so that you can reduce your overall tax burden, helping you optimize your financial picture and boosting your path to building long-term wealth. So let's break down these two concepts so you can see why tax planning is actually far more impactful when it comes to your financial success. So, at its core, tax filing is the process of organizing and documenting your financial history for the year, kind of like writing a financial yearbook. What you're doing is you're reporting on what has already happened, but you're not necessarily taking any actions that could change that outcome. The tax preparer's role here is to gather all of your documents, your W-2s, your 1099s, your deductions, and make sure that everything is accurately reported. So their job is really to ensure compliance with the tax code, not necessarily optimization. So now, that being said, some tax preparers, they may toss in a quick tip here or there. They might tell you, contribute more to your 401k next year, but overall, the focus of their service is more on past events and reporting those past events. There's not a lot of forward-thinking advice baked into that process. So think of it this way. Essentially, filing your taxes is like writing the history book of your financial year. It captures the story, but it doesn't necessarily rewrite it. And with tax filing, obviously it's still a very necessary part of your, annual financial circumstances. So for many of our clients, we do recommend that they do work with someone who can assist them with tax preparation and filing. Now, while tax filing looks backward, tax planning actually looks forward. So it's about proactively charting a course to reduce your taxes, not just in this year, but over your entire lifetime. And so this is where, as that us as financial professionals, we really dig into your tax return, not just to report on what happened, but what we're looking for are opportunities. That's opportunities to save on your lifetime tax liabilities. So maybe that could include timing your income, perhaps shifting your deductions to another year, or planning for your future investments. So unlike tax preparation, which is about staying compliant, tax planning is about staying strategic. It's the difference between reacting and intentionally designing your financial future with taxes in mind. So before we move on, I cannot emphasize this point enough, and this is something I want to clear up right away. When it comes to taxes, it's not just about getting the biggest refund at the end of the year. A large refund for a lot of people, it might feel great in the moment, but it doesn't necessarily mean that you've done the best tax planning. In fact, actually, a large refund often means that you've actually overpaid throughout the year and are just getting that money back. So the goal really should be to minimize your lifetime tax liability, not just focus on 1 year's refund, but planning ahead so you can keep more of your money over time. So who's responsible for helping you with all of this? Oftentimes it's not just your average tax preparer. Professionals like CPAs, certified public accountants, and tax planning focused CFPs with specialized knowledge are really the ones who can help you with this tax planning. And remember, tax planning, it's not necessarily a solo effort. It often involves collaboration between multiple professionals working together to design a strategy that makes the most sense for your unique financial situation. So you want a team of a good CFP and a good CPA for sure. So let's take a look at some real tax planning strategies. These are strategies that we actively employ in our work every day at Azad for our clients. And these are some things that we actively look for when we review your tax returns. So the first there is timing your capital expenditures. So for business owners, the timing of major purchases like equipment or vehicles, they can significantly impact your tax situation. Buying these at the right time can actually increase deductions when you need them most. Next, we have one that we do very often. It's called tax loss harvesting. This involves selling your underperforming investments to offset gains from your winning investments. So this actually can even help you reduce your ordinary income in some cases, and it's a great way to take advantage of a silver lining in market downturns. Another that we highly recommend contributing to retirement accounts like IRAs and 401ks. This is great because they don't only prepare you for the future and your retirement life, but they also reduce your taxable income today. And also, if you're eligible, Roth IRAs are a very powerful and versatile tool for tax-free growth and withdrawals in the future. Um, Another one here that actually deserves some special attention is Roth conversions. So Roth conversions are when you move money from a traditional IRA to a Roth IRA and pay taxes on that pre-tax money now so that you can continue to so that you can enjoy tax-free withdrawals later. So why does this matter exactly? Because deferring taxes forever, so if you're relying on a lot of pre-tax contributions for your retirement, if you defer those taxes forever, it can create what we call a ticking tax time bomb. This is where you have a lot of taxable income that occurs when you move to pull your RMDs for retirement. So if you wait too long, these required minimum distributions can kick in and force large taxable withdrawals at a time when most likely right before retirement, your income may be a lot higher. So you're going to be at a lot higher possible tax rates. So these Roth conversions give you a chance to take some control of that and smooth out your lifetime tax liability. So, we talked about some of the strategies that we can employ with tax planning. And a lot of these can be a little confusing. They can be, um, you know, it can be tricky to know which one is right for you for your circumstance. So this is really where the power of specialized help comes in. High earners and business owners, they often need much more than just the basic tax tips. Their financial lives are a lot more complex, and so are their tax challenges. That's why surface level advice usually just isn't going to cut it for them. So this is where working with a fiduciary financial planner who understands advanced tax strategies can really add value. So one example here, cash balance pension plans. Cash balance pension plans are a powerful retirement structure for your retirement plans that lets high earners and business owners contribute significantly more than these traditional retirement accounts that we just mentioned would typically allow. So these contributions can actually dramatically reduce your taxable income while accelerating your retirement savings. Also for business owners, spreading your income across multiple family members or across multiple entities, this can help reduce the overall tax burden, especially in cases where, perhaps you have lower income family members that are in lower tax brackets. I'm going to go ahead and turn it over to Ata, my colleague Ata, who will review some of the key changes in the tax code with some of the fiscal policy changes occurring this year with the new administration. And then he'll also be looking at some potential future changes that may impact you if the TCJA is actually not renewed by Congress this year. I know it's set to expire. So Ata, why don't you go ahead and take it away from here?
Thank you, Tamim. So each year, the IRS updates contribution limits and other key numbers to keep up with inflation. This includes retirement plan limits, tax deductions, exclusions, and much more. So let's take a quick look at some of the important updates from 2025. So for tax year 2025, the top tax rate remains 37%. And that's for individual single taxpayers with incomes greater than $626,350. And that's $751,600 for married couples filing jointly. The other rates are also on your screen. Let me also add, for single taxpayers and married individuals filing separately for tax year 2025, the standard deduction rises to $15,000 for 2025, an increase of $400 from 2024. For married couples filing jointly, the standard deduction rises to $30,000. That's an increase of $800 from previous year. And for heads of households, the standard deduction will be $22,500 for the tax year 2025. That's an increase of $600 from the amount of tax year for tax year 2024. We do have all the updated 2025 changes on our website. So after this webinar, we will be sharing the link to it when we send out the recording. The gifting exclusion amount has also increased. You'll see that on screens now. And let me clarify, though, that if you pay directly to a college or medical bill, you don't have to report it on a gift tax return. However, if you gift directly to someone over these limits, you have to report it. Specifically, the gifter reports it. That, of course, doesn't necessarily mean it's taxable, just that it's reportable. And as the meme said, there are several significant tax changes that are on the horizon, primarily due to the scheduled expiration of provisions from the Tax Cuts and Jobs Act, the TCJA of 2017. I'm sure you might have seen some ads about that. Trillions of dollars tax breaks enacted by the TCJA are scheduled to expire after 2025, including lower tax brackets, a bigger child tax credit, and a 20% deduction for pass-through businesses. Starting in 2026, individuals aged 50 and older who earned over $145,000 in the previous year from an employer-sponsored plan, such as a 401k, a 403b, or 457b, will be required to make their catch-up contributions as after-tax Roth contributions. This means that these contributions will not reduce taxable income in the year they are made, but will grow and be withdrawn tax-free in retirement. Employees earning $145,000 or less will still have the option to choose between pre-tax or Roth catch-up contributions. So let's talk about tax rates. Unless Congress steps in, individual income tax brackets will go back to what they were before the TCJA after December 31st of this year. This means that the top tax rate is set to rise from 37% to 39.6%, and other tax brackets will shift upwards as well. So what does that mean for you? If Congress doesn't extend the current provisions, you'll see changes like the 12% tax bracket, which will bump up to the 15% tax bracket. The 22% tax bracket will move up to 25%, and the top tax rate will return to 39.6 from its current of 37%. Additionally, the $10,000 cap on SALT deductions, which are state and local taxes, might be eliminated, which could have a big impact on people living in high tax states such as New York, Connecticut, and Vermont. This is something to keep an eye on, and as we plan for the future, proactive management is the way we'll take care of these things. Now, next up is the standard deduction. Unless Congress steps in, the standard deduction is set to drop back to what it was before 2018, though it will be adjusted for inflation. Plus, personal exemptions, which were suspended, are scheduled to come back. These changes could have a big impact depending on your situation. So it's a good idea to start talking to your advisor sooner than later to plan ahead. Now let's talk about the child tax credit. Right now, you can claim a credit for each qualifying child, but there are income limits that cause the credit to phase out for higher earners. Under the TCJA, for tax years 2018 through 2025, except for the year 2021, the child tax credit is $2,000 per child. However, after 2025, it's set to drop back to $1,000 per child, which would cut the credit in half. Now, this is another change to keep in mind as we plan for the future. And like I said, proactive management is the key. Now let's talk about the SALT deduction. Under the TCJA, the deduction for state and local tax payments was capped at $10,000 per year. That was $5,000 for married couples filing separately. This cap is set to expire on December 31st of 2025. Now, while the $10,000 limit was put in place by President Trump in 2017, he changed his stance during his latest campaign, promising to get SALT back if reelected. Since taking office, he's continued pushing for SALT reform. This is another important area to watch as the 2025 deadline approaches. Next, let's talk about the state gift and tax exemption. And gift tax exemption, which is set to decrease as well. As you know, the TCJA made some big changes to tax laws, and one of those changes was doubling down the estate and gift tax exemption from $5 million to $10 million, adjusted for inflation. As of now, that exemption has grown to $13.99 million. But here's the catch. If the law doesn't change starting January 1st, 2026, that exemption is set to be cut by about half. Whether or not you have sizable estate implementing strategies like gifting assets or setting up trusts, which can help reduce estate taxes for heirs, ensuring more wealth is passed on without excessive taxation. So all these changes and more could be happening this year. And we really can't stress enough how important it is to talk to a tax professional to figure out how these changes might impact your specific financial situation. Looking at the major tax changes we've covered, it might make sense for some people to focus on certain income ranges where accelerating or delaying income could have the biggest effect once the TCJA expires. The graphic on the screen shows you that the key income ranges where you'll see the most noticeable differences in your tax rates, but it doesn't cover every possible scenario. Still, it is helpful to know where the biggest impact could happen so you can take action if the TCJA sunsets as scheduled. That being said, keep in mind there is no guarantee that the TCJA will actually sunset. A lot can change between now and December 2025. So it's not just about weighing the potential benefit of taking action today, assuming the law expires as planned. It's also about considering the potential costs if the law is extended, whether in its current form or with some sort of adjustments. In other words, what's the risk if you're betting the law will expire, and what could we gain if that gamble works out? Our main point here is that proactive planning, like I mentioned in the previous few slides, is the key to both avoiding any negative impacts and making the most of the opportunities tax planning can offer. Tamim?
Thank you, Atta. Definitely, we definitely great to hear you highlight all of those changes that are going to be impacting a lot of our clients. I definitely feel like what's going on with these changes are going to be very consequential for people in the way that they are going to be incurring taxes, which deductions they're going to take advantage of, which credits, and whether they itemize or take standard deduction. So thank you for that. So we've talked about the potential changes in the tax code in the future that could happen. But now let's dive into what's already happened. So the Secure Act 2.0, which was actually passed at the end of 2022 as part of a massive $1.7 trillion bill, brought some big updates to workplace retirement plans and IRAs. So let's go over two very important provisions from the Secure Act 2.0 that we feel you should all be aware of. First, there's the extra mega special bonus catch-up contribution. So that sounds like a mouthful, but what it means is that if you're between the age of 60 and 63, you can now actually contribute to your retirement accounts. So the catch-up contribution limit is now going to be 150% of the regular amount, which means that for 2025, that limit is going to be $11,250. Next, there's actually going to be a change for long-term part-time employees uh, and qualified retirement plans. So if you've worked for more than 500 hours in 2 consecutive years, you'll be eligible to participate in your employer's retirement plan. But this change is only going to apply to new plans or those that are updated to include this provision. So this starts in 2025, and it's definitely something to keep in mind if your employer is making any changes to their retirement plan. So also beginning in 2025, the Act is going to require most new employer-sponsored plans to automatically enroll employees with contribution levels that sit between 3 and 10% of their income. And then they will automatically increase their saving rates by 1% each year until they reach at least 10%, but no more than 15% of their income. Workers also are given the ability to opt out of such programs. Employers will have the option to offer Roth matching contributions. This is significant as well, allowing their employees to receive employer matches in a Roth account. So that allows those employer matches to grow tax-free. providing them with some greater flexibility in their tax planning for their retirement savings. And of course, something else that has already taken place is the age at which individuals are going to have to begin taking RMDs from their retirement accounts, so required minimum distributions. This age has actually been raised to 73. So, alhamdulillah, this actually provides some with more time for their retirement savings to grow. And this change applies to individuals who turn 73 after December 31st, 2023. In addition to these, the IRS has clarified this provision here from the Secure Act 2.0, which states that if someone inherits a retirement account and the original owner was already required to begin taking money out, RMDs, the beneficiary must also start taking distributions annually. So moving on, revisiting how what our tax planning strategy really focuses on when we work with clients. So a significant portion of tax planning focuses on what we call these three buckets, and finding the right balance between these three buckets. So this is, taxable income, tax deferred income, and tax-free income. So let's run through these. First, we have what's known as the non-qualified bucket. So this is going to include investments like brokerage accounts, taxable individual accounts where you get a 1099 each year. These are accounts that don't offer special tax treatment. So you're typically going to be taxed on interest and dividends annually, as well as any capital gains when you sell investments. Short terms for short held positions and long terms for long-term capital gains for positions that you hold for more than a year. Um, so the good news here with non-qualified accounts is that long-term capital gains are often taxed at a lower rate than ordinary income. They're a preferential tax. So this can really make this bucket more efficient when it is managed carefully. Uh, Next bucket here is what we call the tax deferred bucket. So this is going to include accounts like traditional IRAs, 401ks with traditional contributions, 403bs. So this is where you contribute pre-tax dollars. So these accounts, they grow tax deferred, which means, you can buy and sell within them and not incur taxes. But so you don't have to pay taxes as the investment grows. However, while this reduces your taxes today, the tax bill is simply postponed. So when you do move to withdraw those funds in retirement, those withdrawals are actually going to be taxed as ordinary income, not under the long-term capital gains rate, as some people might have thought. Um, so taxes aren't just avoided in this situation; they're just shifted to later. Finally, this is my favorite bucket personally. This is the tax-free bucket. These are accounts like Roth IRAs and Roth 401ks. This is where you contribute after tax dollars. So you don't receive a deduction upfront for your contributions to these, but qualified withdrawals, including its growth, are completely income tax free. So provided that you're over 59 and a half and the account has been open for at least 5 years, you can pull out of it. That being said, Roths are a really great versatile tool for tax-free investment growth. So each of these buckets, they have their own strengths. The key to this is, and the key to strategic tax planning is really knowing when and how to use each of these to your advantage. So that being said, I'm going to turn it over to my colleague Reem, who will show us how we do that. And she'll also illustrate for us how tax planning works in a real case study environment. So Reem, why don't you go ahead and take it away from here?
Yeah, thanks, Tamim. We are going now to talk about real-world example of how we approach tax planning. So here's we have a case study for Sami and Sarah, are retired couple in their 70s. They are living in New Jersey, and they have mix of income sources, including Social Security benefits, required minimum distributions, RMDs, from their IRAs account, and investment income from a taxable brokerage account. So over the years, they have paid a substantial amount in New Jersey state tax income. And now they are retired. They are exploring how they can reduce their tax burden and simplify their estate planning. So they are considering to establishing residency in Florida. As you know that Florida is a state with no state income tax. So no state income tax on retirement income, dividends, and interest. So they are interested in saving on taxes now as they began taking RMDs, trying to avoid future state income tax on capital gains from their taxable accounts. And also they want to make their estate plan more tax efficient for their heirs. So these are the goals that they have. One note is that to make, for example, Florida the primary residence for them, they will need to spend at least 183 days. So means like more than half of the year in Florida or in the state that they want to move. So with that, I'm going to share my screen to show how we can model this scenario. So as you see here in the screen, we have two clients, as we mentioned, Sammy and Sarah. So Sammy is eligible for the qualified charitable distributions, which we call it a QCDs. And he has also reached the age where he is taking required minimum distributions, the RMDs. Tara, on the other hand, she is also eligible for the QCDs, but she is, because she is over 70 and a half. However, she still has a couple of years before she will be required to take minimum distribution, so RMDs. So for now, she's not taking the RMDs. And as you see here on the screen, and as Tamim mentioned, there are a couple of tax planning strategies that we can employ or can use for clients, depending for sure on their situation. So for example, if they want to see to do charitable planning, if they are, for example, have a high tax or high income in a year, and they are charitably inclined and they want to do some charitable planning, we can show them how they can save in taxes and achieve their goal in charitable giving. If they want to do the tax loss harvesting, and what is the tax saving with doing the tax loss harvesting if they have losses for a certain year. So all of these things we can model it in our system, but for this example that we are showing you or case study, we're just focusing on the change of state of residency. So let's dive into scenario one. So what we call this scenario as the base year. So scenario one based on 2024 return from the client. So typically we start with the previous year's tax return and adjust it based on what we know for the planning year. And of course, these are rough estimates. It's based on previous year. And we always recommend that the client consult with their CPA or accountant to make sure that the numbers align with the actual situation. If we look at their base year, which is the 2024 here, we can see that for 2024, their income is from IRA distribution. They have $100,000 in an IRA distribution. They also have pension income and Social Security benefits, as you see here. And also they, because they have the taxable account that we mentioned, they will likely generate long-term or short-term gains or losses and they are receiving dividends on the taxable account. So if we look at their total income for the year, it can show here they have a total income around $287,000. And since they are retired, we know that there's no wages for them, but you can see they have substantial income sources. And in terms of deduction, for example, and during the presentation, we mentioned about the itemized deduction and the standard deduction. So a client can either take the standard deduction or the itemized deduction. So the itemized deduction, mainly something like charitable contributions, medical expenses, state and local taxes. So if the itemized deductions are higher than the standard deduction, a client can take itemized deduction. But in this case, the clients, for these clients, the itemized deductions are less than the standard deduction. So they are taking the standard deduction here. So after the standard deduction, their taxable income comes to $254,000. And that's put them into the 24% tax bracket. And here is the federal tax liability. It's gonna be like $46,000. Now, regarding the state tax, for example, we know that they live in New Jersey in 2024. And so they're, according to their income, from like the retirement income, from the IRA distribution, from the pension, and from dividends and interest, their state income tax liability is going to be about, here we can see it, is about $11,000. Now, if we move to the second scenario, as we will show them, like if they move to Florida, for example, and we are assuming here that most of their situation is going to be the same in 2025, same as 2024, because we are using the 2024 as a base year. And we still know that federal is not required to take any required minimum distribution for 2025. And we're like just putting that the dividends is going to be the same. However, if the client anticipate any changes, they can tell us and we can adjust the number accordingly. So the major change here between the two scenarios is the state tax. So moving to Florida, for example, there is no state income tax. So their state tax is going to be zero. So comparing the two scenarios between 11,000 to zero. So in summary, for Sammy and Sarah, because their large portion of their income comes from IRA distribution and investment dividends, so the tax saving from moving to Florida could be significant. But if, for example, we are dealing with clients whose, let's say, income mainly comes from non-taxable sources, or they don't have a substantial dividends or RMDs, the move might not result in a meaningful tax saving. So, what we're trying to say here, it depends on the case. So if you expect like a substantial taxable income sources, then relocating is going to be beneficial. Other than that, it's not going to be very. It's not going to be like beneficial for the client, right? So what are we going to say here? It really depends on the individual situation, and that's why customized analysis is so important. Okay, now we're going to start with estate planning consideration. Continuing in the same case study, Sarah and Sammy wants to make sure that their hard-earned retirement savings are passed on responsibly and efficiently. So they are wondering if naming their revocable trust as a beneficiary of their IRAs would help with that. So to answer this question, trust can be a good solution when you want to control things like delaying distribution for younger or less financial savvy heir. But here's where the Secure Act 2, which we talked about earlier, introduced a major tax trap. So before the Secure Act, certain trusts could stretch IRA distributions over the life expectancy of the beneficiary, but now that's mostly gone. So for most non-spouse beneficiary, like including the trust, the new rule is that the entire IRA must be distributed within 10 years of the original owner's death. And worse so, if the trust is not structured as proper to see-through trust, it gets hit with the 5 years rule, meaning that the IRA funds must be distributed within 5 years, and that can trigger a huge tax bill. And here's the kicker, like the trust hit the top federal income tax bracket, 37% at just $15,450 of income in 2025. So if the trust holds into those IRA dollars too long, the tax bill could be significantly higher than if those assets have gone directly to individual beneficiaries. So what is the takeaway for Sammy and Sarah? So if control is top priority for them, they can name the trust as a beneficiary, but the trust must be carefully drafted to qualify as a see-through trust. And it should ideally be an accumulation trust or conduit trust, depending on the desired outcome, and written to comply with the 10-year rule. On the other hand, if their children are financially mature and a big tax bill is a concern, it may make more sense to them to name the kids directly and use other gifting tool, like, for example, other strategies like gifting strategy, Roth conversion, to manage the overall state and tax impact. So smart planning, like the kind we offer at Azad, means balancing control, flexibility, and tax efficiency.
Thank you for that, Reem. That was very insightful. And I say this all the time. I think our ability to predict financial outcomes of different decisions, it's a very powerful tool that we use for advising our clients. And it's not just something that we do with tax planning, but it's something we can do with your general comprehensive planning as well. So it really helps with some of the paralysis that can occur with making such impactful life decisions, such as moving to Florida, really helping our clients get that peace of mind in that decision-making process. So as we were going along the session, I had some questions coming in here that I think some of the participants would love to have addressed. Let me pull them up right here. All right, so this one, I think this is going to apply to a lot of people who joined us today. So my husband is almost 76. When should he withdraw all of his money from his IRA? And what will be his tax consequence? Reem, would you like to go ahead and answer that?
Yes, so I can answer this question. So for this year, anyone turning 73 must begin taking what we call the required minimum distributions, or the RMDs, from their retirement accounts. And that includes the IRAs, the 401ks, and of course, it does not include the Roth account. So the deadline for these distributions is generally December 31st. But if this is your first, for example, RMD, you can wait until April 1st, 2026. But then, of course, you will have two of these RMDs in 2026. So in this case, for the question, since this person has already turned 76, they have already been taking their required minimum distribution. So he does not have to withdraw all the money at once. He just needs to take at least the required minimum distribution amount each year. So the amount is based on his age and the IRS life expectancy tables. So if he withdraws more than his required minimum distribution, I don't know exactly what is the amount is, but this will be treated as ordinary income and added to his taxable income for the year. And this could also push him into higher tax bracket and may cause like a big tax bill and may impact other things like Medicare premiums, for example. So for most people, it's to work with your advisor to take only the required amount each year. And if you need more, also you can do that. But unless there is a specific reason to liquidate the entire account, we don't think that it should be like transferred, like liquidating the entire account. So this is actually where we working with you as a tax planner is very important.
Yeah, and this is actually where good tax planning becomes very important. It's not just about taking the RMD or the required minimum distribution. It's about looking at your overall income picture. You want to carefully decide how much to take from pre-tax accounts, like the traditional IRA, while also considering your income needs and any other type of accounts you have, such as Roth IRAs or other brokerage accounts. A thoughtful strategy can help manage your tax bracket, so reduce your overall tax burden and make your money last that much longer.
Yeah, and I would just add to that, even though RMDs you don't have to start taking them until age 73 for most people now, that doesn't necessarily mean that you should wait until then to start taking money out of pre-tax buckets. And when I say don't wait until then to take money out of pre-tax retirement accounts, I'm not talking about just pulling out the money, liquidating as cash and just pulling out the money. I'm talking more about strategic withdrawals, strategic options that are available to you. Um, that being said, so just leaving them in the pre-tax retirement account, you could just be letting a big bucket of money grow for Uncle Sam. So helping you deal with that, it's very important, especially at that age. So that window between age 59 and a half and 73 is a very important time to work with your advisor and think through some options. Roth conversions that can help you convert some of that pre-tax money into after-tax money, if that's a tax year where you can afford to take that, some strategic withdrawals, strategic withdrawal options as well. Your advisor could go over with you. That being said, every situation is different, so there's really no one size fits all answer. But good planning during this time can really make a big difference later. So moving on, I have another question here. Okay, so right here. So what are the benefits of paying extra? What is the benefit of paying an extra $10,000 in Maryland taxes while closing a 401k?
Yeah,
Reen,
actually, it really depends on your situation. So distributions from 401k are treated as ordinary taxable income. So most employers are required to automatically withhold 20% of federal taxes when you take a distribution. So unless you are rolling it over to another retirement account, state taxes also might apply depending on where you live. So, and also if you are under 50 and a half, you could also owe 10% early withdrawal penalty, unless you qualify for an exception. And if you don't withhold enough when you take the money out, you could end up with a tax bill and possibly some underpayment penalty when you file your taxes. So sometimes if you expect your income to be lower for the year, you might choose to have less withheld. But most people do stick with that 20% just to avoid any big surprises at tax time. So again, it really depends on your situation.
Great. Thank you, Reem. And I had someone tell me once, the best answer you can ever give is it really depends. And that is true. It's the answer for most things. So it's really important that you work with a financial professional who can help you, take a look at what's right for you. So I have another question here. Oh, this is a good one. You know, I've dealt with a lot of clients experiencing this situation here. So I exercised stock options this year, and now I'm facing a big tax bill. Is there anything I can do to lower it?
Yeah, I can
Anyone
take
want to
this
take
one.
this? Okay, go ahead, Atta.
So this is a really common situation. And first of all, don't feel bad. A lot of people are surprised by how much tax gets triggered when they exercise options. And if you've already exercised and you're now staring at a huge tax bill, there are a few things you might still be able to do before the end of the year. One option is to maximize contributions and any pre-tax retirement accounts you're eligible for, like 401k maybe. And you might also want to look at your investments to see if you have any capital losses you could harvest to offset some of your gains. It's not a perfect fix, but it can help. And another very good option is like as long as you're charitably inclined, as a lot of Muslims are, you could donate appreciated stocks instead of cash. Charitable trusts may also be an option. You could actually transfer the stock to a charitable trust so you avoid the capital gains tax on the appreciation. This is a more complicated strategy, but it can work. We work with our clients, CPAs, to explore these options and various other options to figure out a way forward. So don't feel bad. That's a starting point at least.
Yeah, and I would like to add something here that you're right to focus on the tax bill, but it's also good to remember that a tax bill is not always a bad thing. So sometimes it means that you are making progress, like this de-risking your portfolio or tackling other financial goals. For example, if you have exercised stock options, you are turning paper gain into real gains, which does trigger taxes, but it also means that you have reduced your exposure to a single stock. And that can actually be a smart move if it was a big chunk of your wealth and you want more balance and stability in the long run. So yes, we want to manage the tax bill in a way that works for you, but think of it as a part of the bigger strategy to better financial health. So sometimes paying those taxes is actually a step forward.
Okay. Thank you for that, Reem. And I just want to thank everyone who joined us live today. We really appreciate you taking the time to be here. If any of you are looking for more information or you have any questions, don't hesitate to reach out to us at hello@azadasset.com. And don't forget to follow us on LinkedIn for more updates. So before you go, we'd really appreciate it if you could take a moment to take a quick survey that's going to pop up after the webinar ends. Your feedback really helps us improve these sessions, and it only takes a minute. So thank you again, Jazakallah khair, all of you, for your time today, and we hope to hear from you soon. Assalamu alaikum.
Thank you. Assalamu alaikum.
Let me stop.